So there's a new IPO on the block from a hospital chain called Park MediWorld. They're asking for public investment, but the real question is this a healthy bet? In this explainer, we're going to put their finances right under the microscope. We're going to see if this IPO is a cure for your portfolio or if it's a critical case you should probably stay away from. Right, so it all boils down to one simple question, doesn't it? Is this company financially fit for your money? We're about to check its vital signs. We're talking revenue, profits, debt, the whole shebang, to figure out if this is a golden opportunity or maybe a financial emergency just waiting to happen. Let's get into it. Okay, so first things first, let's open up the case file and see what's actually on the table. What exactly is Park MediWorld offering? We're talking about a pretty big number here. The total size of this initial public offering is a whopping 1,260 crore rupees. That gives you a sense of the scale we're dealing with. Okay, now this is really important. It tells you exactly where all that money is going. As you can see, the huge majority of it, 960 crores, is what's called a fresh issue. That's new money going directly into the company, presumably to fuel expansion. The rest is an offer for sale, which is just an existing owner cashing out some of their stake. The good news here, most of this cash is going right back into the business to help it grow. And that's usually a pretty solid sign for new investors. All right, let's switch gears a bit. Before we get any deeper into the numbers, we really need to understand the company itself. Who is Park MediWorld? So what's their deal? Well, you've probably seen their hospitals under the brand Park Hospitals. They're what's called a multi-specialty tertiary care provider, which is just a fancy way of saying they handle the really complex medical stuff. Geographically, they're all about North India, and this is key, they've really zeroed in on non-communicable diseases, or NCDs. Think heart disease, cancer, orthopedics, that's their sweet spot. And as we're about to see, that's a very big deal. And this right here, this is exactly why that focus is so critical. I mean, check out this stat from an industry report. It's pretty sobering. NCDs are now behind 2/3 of all deaths in India. What that means for Park Hospitals is that they are smack in the middle of a healthcare segment where, unfortunately, the demand is just massive and still growing. Okay, we've got the background. Now for the main event, the part of the investigation you've been waiting for. Let's follow the money. So, let's kick things off with the top line, the revenue. And at first glance, the story looks pretty good. You see that nice jump from FY22 to FY23, but then you hit FY24. And bam, the growth just stops. It goes completely flat. And that right there is our first real red flag. But wait, just when you think things are looking a bit grim, the plot thickens. The very latest data we have from the first half of this fiscal year shows a pretty solid rebound. If you kind of stretch that out for the whole year, it looks like they could get back to around 12% growth. So is the patient making a full recovery? Well, not so fast. Yeah, hold on. Before we get all excited about that revenue, let's look at the bottom line, the profit. And this is where our investigation really hits on something big, a major problem. Because while revenue was just flat in 2024, look at what happened to the profits. They didn't just dip, they plummeted. Profit after tax crashed from 228 crores down to just 152 crores. This, right here, is the central mystery of the Park MediWorld IPO, and we're about to crack it. So that leads us to the million-dollar question, doesn't it? Where in the world did all the profit go? How does a company suddenly become so much less profitable? And this timeline, well, it tells the whole story. See that big profit collapse in 2024? It wasn't some sudden heart attack. It was more like the symptom of a long-term illness. Just look at the EBITDA margin. That's a key measure of how profitable their actual operations are. It started out super healthy at 42% back in 22. Then it slips to about 33%. And then in 24, it just falls off a cliff to under 27%. This steady slide is telling us something is going on with the core business. And for anyone putting money into this, for the shareholders, the impact is, wow, it's stark. Return on equity, basically how well they use your money to make more money, was cut in half. It collapsed from a fantastic 36% in FY23 all the way down to just 19% in FY24. So what's the usual suspect in a case like this? Debt, right? Did they just borrow too much money? Well, we ran the numbers, did a full balance sheet checkup, and the answer is, surprisingly, no. Their net debt to EBITDA ratio is at a very comfortable 0.6x. So this tells us the problem isn't some big financial mess. It's something deeper, something in the day-to-day operations. Okay, so let's recap. We've got a company where revenue growth seems to be coming back, but there's this massive, kind of unexplained hole where the profits used to be. This investigation isn't closed just yet. The file is still open, and here's what you need to be watching for next. So here's your game plan. 3 key leads you need to follow. First, and this is non-negotiable, you have to wait for the price band. Valuation is everything. You gotta see how it stacks up against the big players like Apollo and Fortis. Second, you need to be a detective yourself. Dive into that full IPO report and hunt for the operating numbers. Bed occupancy, revenue per bed, that kind of stuff. That's where the real story is. And finally, you absolutely have to read the risk factors section. That's where they're forced to tell you everything that could possibly go wrong. And all of that, it brings us to our final diagnosis. The patient's growth, it seems to be on the mend, and that's good. But that crazy drop in profitability, it raises some really serious questions about the company's long-term health. So it leaves you, the potential investor, with the one question that really matters. What price are you willing to pay for that risk?